Hello and welcome to Choosify. Today on the show, we have another Mailbag episode with our good friend Rachael Camp. She's a CFP, and this is now her 9th visit here to Choosify to do these Mailbag episodes with me. And they're always a blast because we cover a wide range of topics. Rachael always picks great questions, and these come from you, the community. So we touch on a lot of things here. I'm going to just bomb through a couple of them. Bond funds versus individual bonds, Roth conversions in a down market, advanced FI strategies and the interplay with pensions, Social Security calculations and what gets included in income, solo 401k, Backdoor Roth, RSUs, and Social Security, all of these things in one episode. I think this is going to be a really useful one. And I was especially interested in our conversation about bonds, because I think this is something that is top of mind for a lot of people. And I know Rachael is getting this from many, many of her clients in her CFP practice. So I think you're really going to enjoy this episode. And with that, welcome to Choose FI. Rachael, you're back for mailbag number 9. This should be fun.
Yeah, I love it. Love to be here, Brad. I'm excited.
Yeah, you are the best. I really appreciate you doing this consistently. So you, as always, have picked the questions of all the hundreds of questions we get. We toss on this one Google sheet and you pick out 6 or 7 each time. And we're going to get started. So you have told me that a lot of your clients are asking you about bonds. And that was top of mind for you when you went through the question list. And one came in from Steven. So this is a bit of a long one, but I'm going to try to read it as much verbatim as I can. So I have a question relating to bonds from this week's Mailbag episode with Rachael Camp. So this is a prior one. When discussing asset allocation as you approach retirement, you talked about the importance of having cash and bonds to help deal with sequence of return risk at the beginning. This all makes sense, but it brought up a question relating to bonds. I subscribe to the Simple Path to Wealth philosophy, so most of my bond exposure is in a bond index fund, in this case BND. Over the last few years, the price of the bond index fund has dropped significantly and has been somewhat volatile. I hope this question makes sense, but in terms of positioning yourself well to deal with sequence of return risk, it seems like owning a bond fund may not accomplish that. Does that only work if you buy actual bonds that pay you interest and return your principal upon maturity and therefore aren't really subject to pricing risk? Am I missing something? Any clarity about when to buy specific bonds versus a bond index fund would be very helpful. Thank you for all the great content. Truly life-changing. So, thank you, Stephen. That's really, really kind. And Rachael, I feel like we could probably talk about this for 20 or 30 minutes if we were so inclined. So we're going to give it the best answer we can and as thorough as possible, because frankly, we don't really talk about bonds all that often on the podcast. So I would actually ask you to take a step back for people who just don't understand even just the premise of Stephen's question with like, hey, what happens to bond pricing when there's interest rate volatility? Because this is not intuitive to people, and I think it's really important to set the stage.
Yeah, and I told you, Brad, before we got on here that I was excited to talk through this one because we have so many questions on it. And I do think it's funny because the equity side seems almost simple now compared to the bond side. But that's because for most of history, bonds are just the stable source, and we rely on them for interest coming in. And that's like he mentioned in the question, that's what protects us in sequence of returns risk. What I think a lot of people are starting to learn is about duration and interest rate risk. So this is something that's not talked about often, and we're talking about it a ton now because of what happened in 2022, where bonds acted like stocks. I think a lot of people said that was actually the worst year for bonds ever.
Wow.
Ever, which is crazy. But that's also why a lot of people don't have a lot of trust in bonds anymore. But it's important that we understand why that happened and then also start to understand duration and interest rate risk. So to your point, Brad, there is a relationship between the price of bonds and interest rates. It's an inverse relationship, so it means they do the opposite, right? So if interest rates rise, like they did very suddenly in 2022, when we had Fed interest rate hikes that were really aggressive, bond prices fall. And that's for a very simple reason, right? So if you have a bond, you own a bond and it's paying 2% interest, and then all of a sudden interest rates rise, let's say 4%. Well, now no one really wants your bond at 2% interest when they can go out into the market, get a brand new bond paying them 4%. So that really discounts the price of your bond because in order for anybody to buy it, you have to discount it because otherwise a 2% interest rate on a bond is just not attractive. So the opposite happens as well, right? So if you have a bond that is paying 4% and all of a sudden interest rates drop to 2%, now your bond becomes really valuable. You want to hold on to it. Other people are willing to pay a premium for it. So that's what we mean when we say there's an inverse relationship between the prices of bonds and interest rates. The component I think everyone has to really understand about this is that bond volatility is really dependent on the duration of the bond, right? So if you have short-term bonds, if you have T-bills, which are treasury issued bills from, the US government that are less than 1 year in maturity, it's going to have a very small volatility compared to a 30-year bond, 30-year treasury, right? So the more the duration is increased with bonds with treasuries, the more volatile that reaction and interest rate changes is going to be. This is what I mean when I say I think this is kind of a wake up for us to understand duration and interest rate risk and how that interacts with bond prices. There were some people who felt very comfortable just holding on to long-term bonds, not understanding that there was a lot of underlying risk there, especially in 2022. So I'm curious how you think about it, Brad, because I also have a philosophy on how I approach this duration risk with bonds, but I don't know if you have.
Yeah, this is complex.
Yeah.
Because there's a lot of different factors that come in, and also like psychology of buying bonds too. So for me, and this gets to Stephen's question actually about like individual bonds versus bond fund. And of course, I'm not going to steal your thunder on this, but this is pertinent to what you just talked about, is if I were buying a bond, I'm basically, as I kind of see it loosely, like I'm buying into a contract. So if I buy $1,000 bond at 3% interest at that point, and it's a 5-year bond, I'm basically saying like I'm putting my money down and I'm content with a 3% annual interest on that bond basically for the next 5 years. I bought into a 5-year contract. So at the end of those 5 years, and this also gets to Stephen's question, is I get my $1,000 back. That's how this, and you can correct me if I'm wrong, obviously, but that's how the contract, of course, works on these things. I'm kind of kidding, but in case there was something ridiculous that I missed. But I'm buying into that contract. If I bought into a 30-year contract, my anticipation, maybe in my own simplistic head or just how I think about contracts like this, is I'm literally buying into a 30-year contract. So almost Warren Buffett style with prices of equities. I don't really care, frankly, what the prevailing interest rate is, because I bought into this contract with eyes wide open. And I said, all right, I plan to own this bond for this time period. I'll get my money back. And yeah, I understand the spot price, the current price of that may go up or down depending on the prevailing interest rate, the interest rate as if I were to buy a new bond today. But I made that contract, again, with eyes wide open, and that's just what I'm content with. So maybe that's different, frankly, Rachel, than how a lot of people look at it. But I don't know. I mean, you talk to many, many hundreds of people and clients and such. Like, is that a common sentiment, or is that rarer than not?
Yeah, it is common. I would say with individual bonds, the reason people are attracted to them is because there is some psychological comfort there, right, compared to bond funds. And it really depends how you're using the bonds. So if you are somebody who is actually creating a bond ladder where you're saying in 1 year, I'm going to need this much cash, I'm going to buy a 1-year bond. 2 years, I need this much cash, I'm going to buy a 2-year bond. That can work really, really well, right? Because you are probably not going to care about the price fluctuations in the next few years. You know that return on the price of the bond is coming to you, and that's what you need to cover your spending needs. On the other hand, you have people who are, say, 5 to 7 years from retirement, and they don't really need the cash, but they are wanting a stable part of their portfolio. So that's where I get a lot of questions on, should that be a bond ladder? Should that be a bond fund? And I think where people get confused is they see this comfort with individual bonds and that they mature. And they feel like bond funds don't ever mature, which is technically correct, right? They're continuing to reinvest. It's a rolling maturity. And that only really matters if you need and are relying on that cash at a certain date, right? Which is why when we create a bond strategy, we have short-term needs, intermediate-term needs, and then long-term needs we can get into, because that could technically just be equities if it's long enough. So the difference between a bond ladder and a bond fund is really only important if once those bonds are maturing, you need the cash to spend. Otherwise, if you are creating a bond ladder and you are just continuing to reinvest the bond when it does mature, there's not a difference between what you're doing and what a bond fund is doing. And if it's the same credit risk, if it's the same duration between the two strategies over a long enough time period, there is not really a difference in performance. It's the exact same thing. It's just either you are running it or you're giving it to a bond fund manager to run. Does that make sense?
Ooh, that does. So, right, on a long enough time period, what you're saying is Stephen's concern, which is basically the spot price of that bond fund, will actually ultimately smooth out because it's really just, hey, this is discounted in theory, or there's a premium based on the current prevailing interest rates. But if these underlying bonds are held to maturity, then we are getting our full principal back. So that begs the question, though, are these bonds all held to maturity in these funds? And I don't know if you could possibly answer that, but like, I don't know if there are trading strategies, like what a bond fund manager does. That's something I've never even contemplated before.
Yeah, that's something that depends on the manager. Some of them are just holding to maturity and then reinvesting. Some of them say, hey, in order to hold this duration, we have to sell and then we have to buy a new bond. That does speak to technically if interest rates are rising, right? And you've got this bond fund and the bond fund manager is reinvesting and buying new bonds, whether it's coming from coupons, coming from just bonds maturing, coming from new dollars from new investments, they're actually capturing that rise in interest rates much quicker than you could in your own bond ladder. What we saw in 22 happen was that the increase in interest rates was so aggressive. It was such a sudden spike that it was hard to capture those higher interest rates as quickly. And the current bonds took a dramatic hit. And what people are concerned about is that there was that period of time, and we're still seeing this a little bit, of the increased correlation between stocks and bonds, right? So you hold bonds because when stocks fall, you want that portion of your portfolio to hold up. People are rightfully concerned that in recent years, they have been more correlated than they have in the past. That's the concern and the fear with bonds right now. But again, it speaks to like a bond fund like BND, you have to look it up, see what the duration is. I think it might be like 6 point something years, and understand that if you're going to buy a bond fund like that, that should be for money in 6.7 years then. If you need money in 3 years, you can either look for an ultra short-term bond fund, you can buy individual bonds, you can keep it in cash or cash equivalents. But I think that's the confusion. When we buy these bond funds, we assume that they will always stay stable. That speaks to there's just nothing that is actually a risk-free investment. So that lack of stability, I think, was really shocking to people in 2022. But that is exactly how bonds can act in an environment just like that, like what we saw in 2022.
No, that makes a lot of sense. I love that point, actually. Right. So it's almost like a perceived lack of volatility in a sense, and really capturing the interest rate increases in many cases, right? So as you described, like, okay, you might have a bond ladder and you might just have literally one bond that's coming due each year. And yeah, you have some stability and lack of volatility. But like you're saying, if you're in a bond fund, and this is one of the potential values of that, even if it does look like your bond fund is going up and down on that spot price, but really they have thousands, I'm just making tens of that, whatever it is, of individual bonds. And because those maturities are coming due on a very frequent basis, and in that period of rising interest rates, as you described, like they can capture that larger interest rate, and therefore you're getting more interest income much, much quicker. So the phrase that comes to mind is like the weighted average interest rate. I'm not sure if that's the precise technical definition, but like as that's rolling, that can happen on an almost daily basis, that it's inching up on your bond fund, as opposed to, hey, I just have one bond that's coming due each of the next 5 years. Like, well, you have to wait an entire, maybe 11 months and 28 days if you just bought your last bond to capture any of that interest rate increase. So that's a really interesting point that I would have never considered.
Well, you have to think about it too, where you're holding an individual bond that matures, say, in 5 years. It's at 2% interest. It's bad. And all of a sudden interest rates go up to 4%. You're still holding a bond that is paying you 2% when there are bonds out there paying 4%. So you're still losing in that sense. It just might not feel like it because you know that maturity is coming. You're going to get that return. that you can rely on. So there's a lot more transparency, I guess you could say, within a bond fund. And that's what could be the downside. But I do think it's a psychological comfort that people kind of fall into with buying individual bonds. Nothing wrong with it. Like I said, if you have short-term cash needs, can be great to know that that's coming due, especially if you're in retirement or about to retire. But outside of that, if you're just managing a bond ladder because you think there's some advantage with that over a bond fund, I think that's just a psychological comfort that doesn't actually hold up. You're just now the manager of the bond fund with less bonds, right? And you're continuing to roll them into the next bond. Those bonds are technically never maturing, which is the criticism of bond funds as well.
Okay. So, right. So to get to the heart of, obviously we've talked about the heart of Stephen's question, but even to just answer it precisely. So as you just said, there's a large psychological component to this, but there also is like a real dollar figure in a sense, in that if you wanted to just value your net worth, you would take the number of shares of the bond fund you had multiplied by the current price, and that would be the number that's staring you in the face. And if you had, let's just say, hypothetically, you had 30 or 40% of your net worth in bonds, you had made that decision, and the bond fund had just went down fairly considerably, again, on paper, you're going to see your net worth drop. But I guess the real question ultimately is, okay, has that actually impacted anything in my strategy and or more importantly, in my actual day-to-day? How much interest income am I getting from this bond? Has this really negatively impacted me in any discernible way? And even though I've heard you talk about this for the last 15 minutes, like it still is, I suspect it's very unclear to some people as to like, okay, are we actually saying that on a long enough timeline with the bond fund that none of this day-to-day fluctuation matters, that I'm still getting the interest rate that I expected and maybe even higher? Because in the case of, hey, interest rates went up. So again, inverse, the bond prices of existing bonds, because it's only prior existing bonds, have just went down. So I see my net worth has gone down a little bit, but maybe my interest income has actually increased. So it's this funny side-by-side thing, right? Of like, oh wow, like, hey, bonds are part of my strategy in this case, and I'm getting more interest income, but I see my net worth go down. So I don't know if I should be happy or sad, basically.
Yeah. Well, again, it matters like if you need money, if you need income. And if you do, then hopefully part of your strategy was having cash and short-term bonds that are not going to be that volatile to interest rate changes. This is why I said I think this is a really important question right now. And for the first time, people are starting to understand what duration means with bonds, and that the risk of having all of your money in a bond fund with a 6-year duration is that if that bond fund does take a big hit like it did in 2022, where are you going to draw income from? And that's where a cash account or savings account that can't lose money is important, or a short-term, ultra short-term bond fund that is not going to be that affected by changes in interest rates is important as well. We have to match up when you need the money with the investment. So again, if we're going to need the money in 1 year and you're in a bond fund with 6-year duration, you're taking on some risk there that I really think is unnecessary. And then beyond 6 years, beyond intermediate bonds, there were people in 2022 that were holding 30-year bond funds, which to me was extremely risky for an interest rate environment that was paying so little to be holding onto a bond fund with that duration. I think personally, if I were about to retire, the only way you can convince me to buy into a long-term bond fund is if we were in like a 1981 type situation where we were
18%.
Yeah, something like that. Then you could probably convince me. But there is a risk return trade-off with bonds, and bonds are meant to be the point of stability in our portfolio. I tend to personally think that the long-term bond funds aren't worth the volatility that comes with them.
Yeah, I totally hear you. You want to hear a funny little anecdote, and maybe it shows just quite how old I am, is that my parents were able to stock away some money for a small amount of money for me for my college fund in the early 80s at those absurd interest rates. And it was able to compound fairly significantly to the point where, by no means was my college paid for, but they did a wonderful job by seeing these crazy interest rates. I forget what it was, 15, 18%, something like that. And they were able to put a couple $1,000s in there, and that doubled certainly a couple times in the 16, 18 years that I had left. So I actually was one of the beneficiaries of that crazy period. And who the heck would offer, I don't know if it was what it was. I don't know the exact term, but maybe it was a bond, maybe it was some type of, I don't know, CD or something. But like they had a contractual locked in for 15 years. And it was like, oh, wow, this is remarkable.
That's where you'd convince me. That's where you'd get me.
Total no brainer. But
I'll sign up for that.
Seriously, I would literally every dollar I had. But to your point, like, yeah, when in the interest rate environment is 2%, 2.5%, like, do you really want to lock yourself into a contract for 30 years? It doesn't make any sense. So I think final word on this, and this is ultimately a statement, but really a question to you, just to confirm. I'll act as Stephen here, is, okay, I could buy individual bonds that are going to mature. I will get 100% of the face value back on this. It's guaranteed. It's contractually obligated, obviously, unless there's some default or something insane, but we'll put that aside. Or I could buy a bond fund. And now if we assumed, and this is a big assumption, but in many cases, if that bond fund held every bond to maturity, then they will get 100% of the face value back as well. And it almost doesn't matter what the day-to-day daily fluctuations of that bond fund price are. If on a long enough timeline, if it eventually ran out to it stopped and they did every single bond to maturity, you would get 100% of the face value back. So these fluctuations they're temporary. They're just market fluctuations. And again, if they're not selling the bonds, then those underlying bonds act the same way as the individual bonds that you're buying. Is that a fair summation of this?
Yes. If the way you are running your individual bonds is that as they mature, you are reinvesting them back into bonds, you are doing exactly what a bond fund manager is doing. There is no difference. And like I said, with similar credit profile, similar maturity or duration, the exact same thing is happening within the two. There's very little difference in performance. It's only when you are buying a bond, it's going to mature in 1 year, you need that to spend the money, where I can see an advantage there. Otherwise, you're just acting as a bond fund manager.
Brilliant. I love it. And that's, so you've introduced duration and interest rate risks. I think we nailed this, Rachel. That has been very helpful.
I have a friend who is a bond expert. He'd be better to answer all these questions than me, but I'm seeing it a lot. And so hopefully that's clear.
No, you nailed it. Okay, let's move on here to our next question. All right, Rachel. So the next question came in from Jen. And Jen said, my question is, how does your advice related to Roth IRA conversions and other advanced FI strategies to minimize taxes apply to those of us fortunate enough to have pensions? I'm a federal employee, and I'm sure there are a ton of Fed listeners, but this could apply to others as well, for sure. Will that bump us up into a higher tax bracket in retirement that would negate the tax benefits of some of the strategies discussed on the show? I'm 42, and I don't yet have a separate IRA outside of my TSP, to which I've consistently contributed 10%, but I am considering opening one if it's not too late to take advantage of some of these strategies. So yeah, there's a lot here. TSP, I guess that really is just like the federal government's 401k. So nobody should get too terribly confused with that. Or if you've never heard of a TSP, you don't have one, just think of it as a very similar thing. But advanced FI strategies, timing, lots in here for sure.
Yeah, I get this question a lot, especially, I work with a lot of people who are retired now. And while most of them do not have pensions, a lot of them will have like a small pension, or it will be a portion of their retirement income. So the question I get obviously is, I've got this beautiful tax strategy, but how does a pension fit into this with Roth conversions, with all my other income sources? Is that ruin the opportunity for Roth conversions? But I actually think when you have a pension, it speaks to the importance of Roth conversions even more, right? And the way I like to see retirement is if you retire early, there's really 3 stages to the retirement. Stage 1 is before any of those income sources start. So before Social Security, before pensions, before any fixed income sources, you've got this stage where you are completely creating the paycheck for your retirement. So typically that's a brokerage account or cash buckets where you're drawing from that and you have no other income sources coming in. And that's the stage where we can be really aggressive with Roth conversions, right? Because we're filling up that 0% capital gains tax bracket with the brokerage account for your income. We're using the standard deduction for Roth conversions. We might be filling up the 10 or 12% bracket there too, depending on what makes most sense for you. And I actually think, again, that speaks to the importance of doing Roth conversions even more if you have a pension. Because stage 2, when that pension turns on, now that pension is starting to fill up some of that room in the standard deduction, in the tax bracket. yeah, it's crowding out some room for Roth conversions. So if we were really aggressive in stage one, we got a ton of money over to the Roth side, and we can do a little bit less, right, in stage two because we have a crowded tax bracket now. But stage three is when RMD starts, and then we have way less room. So again, the importance was starting Roth conversions early before pensions kick in, and then maybe doing a bit more when the pension does start, but before RMDs. And then by the time RMDs start, we just have very little control, right? Depending on what we did, because you've got your pension, that is the floor there. It's always going to come in. It's never going to go away. You can't turn it off. So you have to account for that. But now you've got Social Security stacking on top of that and RMDs stacking on top of that. So while it throws in a little bit of a wrinkle, it's obviously not a problem, right? We're going to take the free money. We're not going to let the tax tail wag the dog here. But I really think for all FI strategies, in particular Roth conversions, it actually becomes even more important for anybody that has a pension.
Yeah, I love that. So, okay, so these three different stages. So, right, stage one is the one that a lot of our listeners are familiar with some of these strategies and concepts. I think we should slow down on that just real quick because that's more the fundamental underpinning of really everything we're talking about here. So you mentioned the standard deduction, Roth conversions, and then the 0% capital gains bracket as well. And these are maybe two of the most powerful arrows in our quiver here for FI. And a lot of people, because it's not really relevant to them at the current time. Like maybe they just it's back burner or they just frankly don't listen. But that's why I like to really dive in on this. So, okay, 2025, if you are married filing joint for your tax return, you get a $30,000 standard deduction. Okay, so how that works is basically if you have $30,000 of taxable income, regular wages, let's say, or just ordinary income is the most broad way to put it. But regular W-2 wages would be a perfect example of that. If you have $30,000, you put that on your return and you say, hey, government, please tax me on this. But you get this standard deduction of $30,000 and it just reduces it to zero. Your federal tax liability is zero in that case. Now, as Rachel was saying, if you're in a period where you're in early retirement and you haven't reached that stage two yet, where your pension might come in the case of if you did have a pension, well, you have $0 of income. Now, one of the greatest strategies we have in the FI community is this Roth conversion, Roth IRA conversion. So you basically take, let's say, your traditional Roth IRA, or if you had a 401k, you can roll that into a traditional IRA. And what's cool is you can convert some of that traditional IRA into a Roth IRA. So what it happens is when you try to convert some of this, it's similar to like when you take a distribution from 401k or an IRA, every dollar that you pull out is taxable. Okay. So you are doing, let's say, a $30,000 Roth conversion. So what you do is you take $30,000 out of your traditional IRA and you say, okay, this is obviously a taxable event. So $30,000 goes on my tax return. And now that money gets converted into a Roth IRA, which you never have to pay taxes on again. So when you pull that money out years from now, it is completely tax-free. That's the beauty of a Roth IRA. You pay the taxes up front. And that's in essence, Rachel, what's happening when you're making this conversion is you've put that money in tax deferred into that 401k or traditional IRA. But what you're doing is you're paying the taxes at that moment when you convert it. And then it turns into a Roth IRA. Okay. But what happens, as you know, of course, Rachel, but is the $30,000 goes on your tax return as taxable income. But because you have that $30,000 standard deduction, again, your tax liability is zero. And now you said you might even consider upping it to the point where you're in that 10% or 12% bracket. So this could be another 10, 20 plus $1,000 very easily that you could convert and only pay a tiny, tiny, tiny little bit of tax on that. So that is an incredibly valuable strategy. And I think one of the strongest things we have in the FI community generally is, hey, you can put this money in tax deferred at your highest marginal rate when you're making a lot of money in your job at your highest earning years, and then get it out, pull it out years later at virtually zero tax or very low effective tax rate, which is marvelous. And then final word, and I'll let you jump back in here, is those long-term capital gains at 0%. This is one of the wildest things because it's not an insignificant number. I know for 2024 is 94,050, and I think I'm seeing, or AI, Google's AI is telling me it's 96,700 for married filing joint for 2025. So these are massive amounts that if your taxable income is up to that and you have capital gains as part of that 96,700, the long-term capital gains, that's very important. They are taxed at a 0% tax rate. So in this case, you could have unrealized capital gains, long-term capital gains in your normal brokerage account, your taxable brokerage account, and you can say, oh, I don't need this money right now, but I'm actually going to sell these and realize the capital gain, put it on my tax return, please tax me. But as long as my taxable income is below that 96,700, then I pay $0 of tax. I can then just buy other stock securities. I could rebuy that fund, whatever it is, and I've paid zero tax. So I've increased my basis on this. And that tax, that unrealized tax that I now realized is 0%. I never pay $1 on it. So everyone listening, like you're seeing hopefully light bulbs go off in your brain of these are the two most remarkable things we have going in the FI community. So Rachel, I love this concept of this stage one.
In this stage one, if you're pulling from cash for your income and brokerage accounts for your income, a mistake I commonly see is we're not filling up the standard deduction at all. One thing we don't want to leave on the table is that standard deduction, the $30,000 that you get zero taxes on. So an important part in this stage is to make sure that you do fully fill up the standard deduction with a Roth conversion. And what might happen is, say you need 80K in income, 50% of your brokerage account is gains, we'll say. So what happens on the tax return is you've got 40K realized gains as long-term capital gains. That's going to be taxed at that 0% tax rate because you're under the 97,000 threshold. On top of that, you can do a $30,000 Roth conversion and pay no taxes on it. And at that point, you've got a 30K Roth conversion over, no taxes paid. You've got 40K in long-term capital gains. Now you actually have even more room. We're going to want to go back and either harvest some gains or do more Roth conversions or fill this up a little bit more. That's really the beauty of stage one is we have so much room that we can play with Roth conversions and with your income. We have this really sweet spot of being able to take out a lot of money at a low taxable income and make sure to get those dollars over into the Roth account.
Yeah, I like that. I like that a lot. So yeah, these are your years where you can just massively benefit. So before, in this case of Jen, a pension comes in, or like you said, before other income, RMDs or Social Security, which impacts it also. So yeah, I think we all just need to be very, very aware of standard deduction and 0% long-term caps gains brackets. Those are the two things that in the years you can take advantage of it. You don't want to leave any money on the table. This is literally free money. You can take these taxable events very purposely and say, please tax me on it. And then the government in their infinite wisdom says, I'm going to tax you at 0% because, I mean, they are incentivizing certain habits, right? So I do understand it and it's wonderful and we can take advantage of it. So why not do it to the fullest extent? So, okay, that all makes sense. And yeah, like you said, stage two, stage three, those tie in to the larger question. We don't need to adjudicate them, but I guess just finally on Jen's, she said something about like a separate IRA. Is it too late to take advantage? Is there any reason not to do this? I don't know if this is necessarily all that pertinent. I think if you can benefit from it and you're in a period where you have a higher marginal rate, you're still earning some money, I don't see any reason not to personally. But yeah, it just seems like mostly a side question.
Yeah, it's a tax arbitrage issue, right? We're trying to pay the least amount in taxes over our lifetime. So with the same argument of the Roth conversions of, do we want to fill up the 10 or 12% brackets? Well, that depends on what you anticipate RMDs being. If they're large enough, they could bump you up into 22, 24%. Now all of a sudden, 10, 12% brackets look really attractive. So it would be the same concept when you're contributing. What bracket are you in?
Yeah.
Do we want to take advantage of that? Do we want to defer taxes? That's how I always look at it. It's a lifetime tax rate today versus the future.
Yep. Love it. That's exactly right. Where I usually fall down on putting money into pre-tax vehicles, so think traditional IRA, 401k, et cetera, is control what you can control. And if you're in a high marginal tax bracket now in your earning years, I like to fill those up as much as possible because I think with many of these advanced FI strategies, I will be able to pull the money out at a dramatically lower effective tax rate. So that's kind of just my broad view. Of course, your situation may differ. You might have different needs, et cetera, yada, yada, yada. But that's a pretty high level, the general concept of what we talk about at Choose a FI. All right, Rachel. So let's move on to Doug's question. And this is another one about Roth conversions, but this is actually a more timely one. So, Doug's question, one thing I haven't heard you talk about, though maybe I missed it, is the timing of Roth conversions. Specifically, the idea that if you have a mindset that the market is heading higher from here, now is the time to do a conversion. Had you converted 100 shares of, let's say, SPY at the recent high of $613, you would be taxed on $61,300. If you had converted at the recent low, you would have only been taxed on about $49,000. Just thought it may be worth pointing out to listeners. So, Rachel, I know you identified this as something that is A, very timely, B, you're getting questions from. So I'm a little uncertain as to the actual question. So I'd love to hear your thoughts on this.
Yeah, I mean, the way I interpret it is, okay, so of course we think the market's going to be higher in the future, right? But if we go through a market downturn, is that an opportunity for a Roth conversion? He points out the fact that share prices drop dramatically, which means with the same dollar amount, we can actually get more shares over, which is a valid point. So the reason I was excited to talk about this question is because in April of this year, with the tariffs, with everything that was happening, we obviously experienced a big downturn in the market. Talked to a lot of clients, talked to a lot of people about Roth conversions at this time. The way we approach Roth conversions, right, is we figure out what's the dollar amount we want to convert this year. Sometimes we have to finalize that at end of year when we figure out what all the other income sources were. But if you are in retirement, you know you want to do a Roth conversion. Say you've earmarked $50,000 with your tax strategy for a Roth conversion. And then all of a sudden, middle of the year, a huge downturn happens and you're wondering, should I be doing this now? Should I be doing half of it now? Should I be more aggressive right now? Because the idea is when the market is suppressed and when your account value is down, that same 50K is now a larger percentage of your pre-tax account that you are converting than it was when it was at market highs. So that's the idea. I mean, we can phrase it two different ways. One way to phrase it is it's a larger percentage of your IRA that you're getting over. The other way to phrase it is now we can get more shares over at that same $50,000. That's the idea. And then now it's in the Roth account where those shares, where those dollars can recover in a tax-free account. So I think that the heart of the question here is if we see a opportunity in the market where it drops, is that a time to be more aggressive with our Roth conversion strategy or just to jump on it and do the Roth conversion at that point?
Yeah, this is fascinating. And this is where personal finance is just so interesting because there are things that some people consider. Obviously, you've heard this from other people, not just Doug here. But for me, Roth conversions has always just been about the tax liability. So for me, I almost am agnostic as to like what just happened in the market, et cetera, et cetera. I'm just trying to move dollars over to convert dollars in essence. And how can I fill up my buckets like we just talked about with the standard deduction and maybe inch into the 10 or 12% bracket. But yeah, that is a fascinating thought of like, okay, but what I'm actually looking to do is get shares over for my long-term net benefit of the like net worth benefit of this. It's really interesting, Rachel. And I don't know if I'm convinced that this ultimately matters. And I don't mean to make light of it, but I'm not 100% convinced. But yeah, I mean, if you have, like Doug's saying, if you have that mindset that the market's heading higher from here, and like you said, and I want to be clear to everybody, we are not prognosticating on what's going to happen in the market. We couldn't possibly know.
No idea.
Right. Like if you put a truth serum to us, like what are our thoughts over the next 3 to 5 years? I suspect it would be very different than what's going to happen over the next 50 years. Over the next 50 years, I am pretty darn sure approaching 100%. That chart of the market is going to look like it's looked the last 100 years. It's going to be up and to the right. Now, are there going to be periods of volatility? You bet there will be. There obviously will be. There always have been. There always will be. But barring a zombie apocalypse or some AI takeover of the world, which is now my updated version, Rachel, of the zombie apocalypse, I'm pretty sure that's going to be up and to the right. So yeah, I mean, it's vaguely convincing to me. But I think at the end of the day, like what we're really doing with these Roth conversions is how can you do this and get that money out of there paying very, very little tax. So yeah. I do want to take a quick step back and of course, let you respond to that. But are there any other things that clients are coming to you with in terms of market volatility, in terms of hey, I'm worried the market's going to go lower. What should I do? Like even down to like nuts and bolts and or psychology. Is there anything that's people are scared right now? And I'm curious if people have been coming to you with anything in particular.
Yeah. And to an earlier question, a lot of it does deal with that sequence of returns risk, right? So some people will even delay retirement because of fear around the market. I'm not going to discount anybody's fear right now. I think everybody who has some concerns is certainly valid. I will say this is something I have been hearing for my entire career of this can't continue. When's the downturn going to happen? And to some people's point, I understand the concern. The market has looked expensive for a very long time. But this is why we have certain strategies within the FI community and why we have plans in place for sequence of returns risk. This is why we don't, when you're retiring, don't put everything in equities. We have a cash bucket, we have a bond bucket, and that's, I know, the other concern as well. But if you understand how to set up the portfolio to protect you in that first 10 years of retirement, then we're really talking about time horizons of 10 to 15 years for the market. That's the thing I always remind people. So there are people who are retired and are rightfully more concerned because now they need this money. But the way that we do this from a psychological standpoint is create like a bucketing strategy, right? So we've got your money for the first 1 to 3 years, the next amount of money for the next 5 to 10 years, and then we've got your long-term money past that. So when it comes to equities, whether you're retired or you're approaching retirement, you have to reset what your time horizon is, right? So if we're concerned about the price of equities, well, if we've got short-term money and we don't need to touch our equities for 10 years, then we have to worry about it in the time span of, well, where do I think the market is going to be in 10 years, 15 years? And if we look at history, often it is up and is up by quite a bit. I always put myself in the position of, if we have a market that is down for 10 to 15 years, well, we're all in terrible positions. Right. We're in a very bad scenario. We've got probably a lot bigger problems. But I completely understand it. And this is what I talk to people about every day. This is why we have these strategies in place to protect certain portions of our portfolio. I know people are concerned about the US market as well, especially with the recent downgrading of the US credit. We can look at, international options for that. But for the most part, I like to just think of it, we're all in this together. If we have a brutal few decades, we're all going to have a lot bigger problems. I don't know if that's comforting to other people like it's comforting to me, but that's how I think about it.
Yeah, it's funny. That's my joking zombie apocalypse thing.
Yeah.
It's like you can't plan for the 0.00001 edge case because listen, if the zombie apocalypse comes, we're all going to be screwed, right? Not to be too crass about it, but so within the range of normal and understanding that outlier events happen all the time. Nobody can predict. Morgan Housel talks about this. Nobody can predict a lot of the things that have actually moved the market. But still, you look at that graph over 100 years through world wars and everything in between, it's still up and to the right. So barring the actual civilization ending thing, I don't see anything that's going to end that up and to the right over a long enough time period. And that's not to say that, like you said, we could have a decade, we could have 15 years where things are flat or down. And we just have to be prepared that that conceivably could happen. So it's not fear mongering. It's just reality and understanding over a long enough timeline. I think we're all going to be pretty darn happy with investing and our strategy. And like we always say, like with a significant savings rate, 30, 40, 50 plus percent, even 20 plus percent, you're going to do okay. And I think that's the thing that we all need to come back to and just kind of take a deep breath.
Yeah, I like to remind people at this time what investing actually is. It's investing in companies. As we hold stocks, we are all partial owners, very small owners of all these different companies within the US and abroad. For bonds, we might be investing in the US government. So when I think about the largest companies in the world, when I think about large governments, if those things aren't doing well, we're going to have a lot bigger problems. But that's what investing is, right? We are owners within companies. We are maybe putting our safe money in governments. So to me, I don't know what the alternative would be outside of something like that. That's not safe, or if that's not something that we think is going to do well, what's the alternative? And I don't have a good answer for that.
Yeah, I totally agree. All right, Rachel, I think this next one can probably be a fairly quick answer, but I suspect this is something that will impact some people. So James wrote in and said, let's say one retires early, manages one's income to maximize HCA, our subsidies in the healthcare.gov and whatnot, and also some of these Roth conversions, and then one inherits a sizable amount of money, let's say 401k or traditional IRA from a surviving parent. That money must be taken over no more than 10 years and has the potential to, as taxable income, screw up one's FI planning. What then? What strategies are apt? Do you take it all during 1 year, or instead of over 10, do you spread it out? And I think my editorial on this is we are optimizers, and I think that's
To a fault.
right, and that jumps out in this question. And James, I love the question. Let's be clear, but it's like, okay, I have all these cool strategies, and like a lot of us are planning on these Roth conversions and the 0% capital gains, and we have our FI number, and everything's golden. And then boom, 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 like James is saying, like I just got who knows $1 million from this inherited money, and now it screwed up all my cool FI stuff. But the subtext is, oh, but I just got $1 million, right? So it's a very good problem to have, clearly. But nevertheless, James may have planned for this for 15 years on his FI journey, and now he has some other considerations. So
Sure.
Someone who receives a large inheritance, someone in the FI community who received a large inheritance, what are the real high-level things that you tell them as far as this goes?
Yeah, first off, this is a great way to screw up the tax strategy, right? More money. Not going to say, just like the pension, we're not going to turn that away. And just because we have to pay taxes on it doesn't mean it's a problem, right? This is just additional income. I think we can get tripped up in our perfect tax strategy and forget that taxes is not the final picture here. The final picture is what's that income coming in? And if I have to pay more taxes because I'm getting more income, good problem to have. Under the context of course, this is not a fun way to get more income with inherited accounts.
Of course.
But what I do with inherited accounts, and we did a super deep dive in this on a previous mailbag because of all the changes with inherited accounts. So that's what I would recommend everybody go back to if you want to really understand the nuance of who this affects, who it doesn't affect. But for inherited retirement accounts, for most non-spouse beneficiaries, the new rule is you have to take it out within 10 years. So just like you would do any retirement income strategy, I would just look at your next 10 years and see if there's any strategic withdrawals you can make within the next 10 years, right? So if you're retiring, but you've got a good 5 to 7 years before you're going to turn on Social Security, maybe you advance the withdrawals and take out more in the next 5 to 7 years. On the flip side, let's say you are starting the Affordable Care Act, you're jumping on Marketplace for health insurance, you need subsidies, maybe you're careful until you hit Medicare age. And then, if you're working right now and you inherited an account, but you're retiring in 5 years, maybe you delay withdrawals to 5 years. There's no perfect way to position this without knowing your very specific situation. But the way I do it with every client, the way I would do it for myself in this situation is I would look at my next 10 years, see if there's any lumpy income coming in and maybe avoid that year for withdrawals or do minimal withdrawals that year and see if there's any years where income is really dropping, like retirement. If nothing special or unique is happening in the next 10 years, then maybe we just take a portion of the account every year as equally as we can. The risk, of course, is that we do nothing for 9 years and then we have that 10th year. And if it's a massive account, you're going to have a big tax bomb. But that, like any retirement income strategy, you now just have to add this as a layer to your income and see where it fits.
Yeah. And of course, you need to look at how much this inheritance actually was and such. But yeah, like taking it in 1 year because it's going to hit you up
Unless
into
it's
those
really low, it's usually not a good idea.
Yeah, that's not your greatest strategy. So yeah, I cannot personally envision a scenario where I would ever want to take it in 1 year. Just Google marginal tax brackets and you're going to see real quick that's probably not ideal. But yeah, okay. Rachel, I like this. Thank you for the answer on that. I think that was very helpful. So, all right, let's move on. We've got a couple more. We'll do Betsy's question. I have a question about the recent episode on Social Security. My wife and I have both worked in high tech where a significant portion of our compensation is from RSUs, which is restricted stock units. I looked at my Social Security Administration statement and it appears to only reflect my salary. Is RSU compensation not counted for Social Security benefit calculations. Now, Rachel, there is probably a decent percentage of the community that might have some RSUs. So this is not uber niche here, but I guess the maybe larger question is, are there other things that might not count into Social Security benefits that people might be missing? Is this really maybe much ado about nothing because the income limits to get your full Social Security are pretty low and we really shouldn't stress too much about it? I suspect your advice might be to look annually at your Social Security statement and to log in and just kind of make sure nothing egregious is happening. But yeah, I just threw a lot at you, but these are the things that I consider when it comes to Social Security. So Betsy's question, but then yeah, maybe the step back at the larger question.
Yeah, with Social Security, we don't have much control here, right? We have a Social Security tax. It's taxed on our covered earnings. Restricted stock units are included in that in covered earnings. The way you can see it if it's being taxed is it's called FICA tax, right? So you'll see that percentage coming out for Social Security. You'll see that percentage coming out for Medicare. Where you might get tripped up with RSUs is when it comes to equity compensation, which I think is like the new pension. A lot of people are now getting equity compensation. With RSUs, it's actually one of the simplest forms of equity comp, but it still can be a bit confusing. So you have a grant date. That's when your employer says, hey, I'm going to give you these shares, but not yet, right? They're going to vest in 1 year or 2 years. So you have the grant date where nothing happens from a tax perspective. So if you're looking at it and you're thinking, oh, well, I got this many shares on the grant date, why didn't I get taxed yet? Is because there is no tax impact on the grant date. The tax impact happens on the vest date, and that's when you actually receive the shares, and then you can decide what to do with them from there. But the point where they vest, that's when they are taxed. And that's where if you are under the Social Security wage cap, they are going to be taxed as Social Security. The other thing that might be happening here is just that you have hit the Social Security wage cap. In 2025, it's $176,100. So if you make more than $176,000, not all of it is going to be taxed for Social Security. They do cap it at that point. The only time really where we can be strategic with Social Security is if you're self-employed and you're paying yourself a salary and you're thinking, I'd really like to max out my Social Security. That can be part of how you think about the reasonable salary. But for everybody, for all employees, for everyone who doesn't have much control over that or compensation, it's very simple. Whatever you make under $176,100 or up to $176,100 is taxed as Social Security. Everybody here can log on to ssa.gov, grab their Social Security statement. If you'd like to take a look at what your Social Security is projected to be, see what they have for your earnings in previous years, make sure it looks good. And that's about it with Social Security. It's simple.
Yeah, nice, straightforward answer for sure. And yeah, I definitely advise people to create that account and just take a look at it every year. I know I have that as something in Todoist that I do once a year and just log in and kind of eyeball it. Like you said, one of the coolest things is you can see your projected benefits, which is really nice.
But be careful with that. They usually project it higher because they're projecting whatever you're earning as you're going to continue earning that. So that's the only thing that gets some people in trouble. If you are retiring next year, but your earnings maybe 10 years ago weren't that high, your benefit might be inflated a bit. So you do want to make that correction.
That's a brilliant point. Brilliant point. And yeah, of course, just like always, we cannot prognosticate what's going to happen with Social Security. But I think I've never heard an actual expert on Social Security say that we're going to get less than 60%. You always hear these horror stories of, oh, Social Security is going bankrupt, blah, 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 blah. And it's like, okay, let's all take a deep breath. It's really not going bankrupt. It's just the definition of bankrupt is a little different than what we think, which is bankrupt equals paying $0 of benefits. I've never heard an expert say we're going to get less than 60 or 70% of what we're anticipating as current projected benefits. So, of course, I'm not saying that definitively. Don't come back to me in 20 years and say, Brad, you got this wrong. I'm not saying that. I'm saying this is what the experts are saying right now. So even if you wanted to take, okay, here are my projected Social Security, because Rachel, a lot of people in the FI community get into, oh, I'm expecting 0 from Social Security. That's ridiculous. That's as ridiculous of a thing as you can possibly think, frankly.
There would be riots.
Right. Imagine the scenario, right?
Yeah.
Like it's very hard to imagine that scenario. So that's another one of those like, okay, let's actually game this out. So take a 20, 30, 40% discount on it. Okay, at least I can make the case for somebody plausibly doing that. And then just move on with your life and don't stress about this again. So, all right, Rachel, we got one last question. Josh said, I listened to the most recent Mailbag episode with Rachel, and the last question made me think of a follow-up regarding rolling the pre-tax amount of an IRA into a 401k. If one has any self-employment income on a 1099 and can therefore set up a solo 401k, could this same strategy be used, assuming the plan chosen was one that allowed transfers in? My wife is in this situation where she doesn't have a 401k at work, and she also can't do a backdoor Roth conversion because she has money in a pre-tax IRA. This would help solve that, but just wondering if I'm missing something. So Josh's question, I'm going to let you run with this because, I think there's certainly some nuance here. I'd love to chime in after you give your real answer.
Yeah, this might seem like a really specific question. The reason I picked it out, though, is because I notice a lot of people in the FI community do some type of consulting work on the side, or they're transitioning into retirement, so they do consulting. So a lot of them actually end up with some self-employment income. And for anybody that does, and they're wanting to clean up their IRA, their pre-tax IRA, because they're wanting to utilize the backdoor Roth strategy, this is something you have available to you if you have self-employed income. You could go ahead and open up that solo 401k, make sure that it accepts rollovers from IRAs. That's a very key point here, although a lot of the large providers do, but make sure that's set up into the plan. And then you could take that IRA, roll it into the solo 401k, and then at that point, do the backdoor Roth strategy. It's important that your wife does have self-employment income. You don't just open it up under an LLC and she no longer has that self-employment income. In order to open this up, that is a key component to this. But yeah, it's to answer it very quickly, it is something you can do to clean up the IRA if you want to.
Yeah, this is very interesting. And I think for a lot of us, we look at that backdoor Roth IRA, and let's be clear, this is very different from the Roth IRA conversions that we were talking about before. And say there's just like a lot of nuance and things that are just like, oh, if I have, as the question asks, like if I have traditional IRAs, like, can I really do this? Is the juice worth the squeeze ultimately? And Josh in this scenario is trying to come up with a way, like, is there a workaround where instead of putting the money into an IRA, which would further complicate the backdoor Roth conversion, could I just get this into this solo 401k in this scenario and then just clean up any of this possible concern? So yeah, I mean, it's a, like you said, Rachel, it's a pretty cool strategy, but most importantly, make sure she can actually open up this solo 401k. There's nothing untoward going on here. This is like a legit thing you can open. And then, yeah, that's a pretty cool way to get around that. I like it.
Yeah. And if you, like I mentioned earlier, if you have consulting income on the side, or if you have a transition period into retirement where you do full-time consulting and you've got some self-employment income, solo 401k is a great way to get more money into 401k accounts. You also get to, as a self-employed individual, you get to contribute as the employee and the employer. If you have a W-2 job and self-employment income, that does not increase your overall 401k limit, so be careful of that. But it does unlock the employer side if you have enough income and can justify that.
Right. And that can be tens of thousands of dollars extra. The we all know about, I think it's what, 23,500 maybe is the employee side of a 401k. But yeah, there's this employer side, which you think of as like your match in this scenario. But when you're the employer, you also have the ability to do that. And you don't have to set your limit of a match at like 3%. I think at last check, it was somewhere around 25% or something. You can do up to a very significant percentage. So of course, do your own research, consult your tax advisor, et cetera, et cetera. But yeah, that's something that could unlock additional many tens of thousands of extra dollars each year you can put into those 401ks.
Yeah, just like the Mega Backdoor Roth unlocks that extra limit, which is your plan has to have it set up through your employer to allow for the Mega Backdoor Roth. This is the same thing that we're talking about where you're unlocking the employer side, because the overall limit is 70,000, 70. Yeah. So there's a lot untouched if you're an employee.
Right. So it's literally $46,500 extra. So it is massive, massive. So, all right, Rachel, we bombed through our 6 questions plus a couple other things that I threw at you. So as always, this is a lot of fun. Thank you for bringing your expertise. And yeah, I really enjoy these. So, okay, as always, I ask you, where can people find you?
Yeah, so Camp Wealth on most social media, RachelCampWealth.com is my website. I'm sure it'll be in the description, but I spell Rachel a little differently. So make sure to click that link and not just type it in.
Yep. So Rachael Camp Wealth. And Yeah, Rachel, as always, this has been a lot of fun. And until next time, we'll do another mailbag number 10. You're quickly
Double digits.
becoming, yeah, maybe our most frequent guest here on Choose a Buy. I love
Love
it.
it.
Love it.
Love being here. Thank you, Brad.
Everyone, thanks for listening. Thanks for being part of the community. And please send in questions. So we have a new functionality at the Choose a Buy website. If you go to chooseabuy.com/feedback, we now have our amazing friends and experts in a whole range of categories who are answering these questions. And they're going to respond most of the time in voicemail. We're going to turn it into an amazing piece of content. And those will live on the Choose a Buy website. And a lot of those will be played here on the podcast as well. So this is something where, hey, if you have a question about safe withdrawal rates, Karsten, Big Earn from Early Retirement Now, is going to answer these questions. If you have a question about SlowFi and CoastFi, Jess from the Pioneers, going to answer these questions. You have Chad Carson on real estate. You have all these incredible experts. Rachel, I'm going to ask you if you wouldn't mind, but I love doing these mailbags. So maybe we can keep this as our own little fiefdom here. But yeah, there's a lot of really cool stuff going on the Choose a Buy website. Jonathan, who is my longtime co-host here on the podcast, is really building something incredible for the FI community. So check it out, chooseabuy.com/feedback. And if you have real questions, you're going to get answers from these incredible people. So thanks for being part of the community, and thanks for listening to the podcast.